Good, let's do young accountants. Now, this is a very good revision question because it's only bullets 10 to 13 that actually has something to do with inventory. For the rest of the question, it's really a financial statements question. And what I like about the question, it's not a typical financial statements question. What I want you to do is to do the journal entries for points 1 to 9, which is general financial statement stuff. The B part is the inventory stuff. Inventory is only points 10 to 13. And then point 14 and 15 is adjustment entries. So really, inventory doesn't form a big part of this question. However, it's a good part of the question. Let's have a look at the information in the question. You're the accounting clerk in an accounting firm, Young Accountants in Johannesburg. You receive the following pre-adjustment trial balance from one of your clients, Ronix Traders. The bookkeeper of Ronix Traders prepared the trial balance for the financial records but is unsure how to treat some transactions. He has asked you to help with certain outstanding entries. Ronix Traders is not registered for VAT. Very important. And then it gives you the pre-adjustment trial balance for the year ended 31 December 2013. Now, when we scroll through the trial balance so that we know what are we working with, we see that we have capital drawings, land equipment, accumulated depreciation, and we see here we have an opening balance there. Delivery vehicles, accumulated depreciation on delivery vehicles, opening balance. Investment in Aspa Bank, inventory, and there we also see that we have an opening balance, and because we have an opening balance there, we know immediately that this is a periodic inventory system. Then we have debtors, bank, cash and cash equivalents. We have allowance for credit losses, and again, we sit here with an opening balance of 750 Rand. We have creditors control. We have line from line bank with a big question mark, so obviously we will be required to do some calculations. Sales, and here our thoughts about the periodic inventory system is confirmed. Here we see we have a purchases account, and in that purchases account we know that we are going to account for all purchases for the year of inventory items. Then we have a purchase related cost here, and in all periodic inventory systems we know that all the additional cost associated with the acquisition of an inventory item, all of those additional costs will have their own account in the general ledger. And it's only at year end that this little in-between accounts like freight charges, delivery charges, import duties, all those kind of account balances, that will be transferred to purchases, and eventually it will end up as part of my cost of sales calculation in my income statement. In a periodic inventory system, cost of sales is not an account balance. Cost of sales is a calculation. Opening inventory plus purchases plus purchase-related cost less closing inventory will give me my total cost of sales. We have freight charges on sales. Now, sales has got absolutely nothing to do with purchase costs. That is a normal selling cost, so normal operating cost. We have customs duty here, which is a purchase-related cost. It's all about the acquisition of those items. Rental income, advertising costs, salaries, and here they were very kind. They've told us that this is gross salaries. They should not or could not or would not and was not supposed to tell you that it's gross. You should know that salaries expense accounts always represents the gross salaries. And then we have a number of salary type of accounts, but they all have credit balances. So that means this must be the creditors accounts, the deduction accounts that should be paid over to the third parties. Pay as you earn. UIF contributions by the employer and the employee. Pension fund contributions by the employer and employee. And then we have general expenses, and we have a lot of question marks. Okay, now the first part of the question, you have to journalize all the information in points 1 to 9 of the additional information for the year ended 31 December 2013. Let's start with number 1. A fixed deposit investment was made at Asper Bank on 30 June 2013, so in the current financial year. The interest rate is 9% per annum, and if they don't tell you anything further than that, you must assume that this is simple interest. So if we're going to see where is our little investment, there we have investment in Asper Bank, 20,000 Rand. So obviously what we want to calculate is the interest that we were entitled on during the current financial period, which obviously, well, we can have a look here, but here's no interest received account. So obviously we haven't made provision for that interest that belongs to us. It is for a period of 6 months. So the total amount of interest is 900 Rand that we are entitled on. So our first journal entry, we're going to debit interest receivable or accrued income, whatever you would like to call it, with the amount of 900 Rand, and that income receivable or that interest receivable is a statement of financial position account. So this is part of other debtors in my trade and other receivables note, so this is an other receivable. And then interest income, our income statement account, our income account would have been credited with the 900 Rand. Please don't forget to put your statement indication whenever a journal entry is asked from you. So we're going to debit a trade receivable account with 900 Rand, and we're going to credit an income account with 900 Rand. Right, the next one. The debtor is insolvent. We receive 72 Rand from the estate, which represents 40 cents in the Rand for the outstanding debt. So we can work out the total outstanding debt. If we receive 72 Rand and that represents 40 cents in the Rand, it means that the full outstanding balance was 180 Rand. 72 Rand we have received, so we would debit bank with the actual amount received of 72 Rand, and we would have credited our debtors account with the amount of 72 Rand. The difference between the 180 Rand and the 72 Rand, which equals 108 Rand, that is the credit losses that we're going to write off. So I say this guy is not registered for VAT, so VAT doesn't play a role. So we would debit credit losses with 108 Rand and credit debtors with 108 Rand. So in totality, bank would have been debited with 72 Rand. Credit losses, the expense account in the statement of profit and loss, would have been debited with 108 Rand, and our debtors control account would have been credited with a full amount of 180 Rand. Number 3, it was decided to transfer debtor with a credit balance of 393 to debtors. So if it had a credit balance in our books, how are we going to get it out of the debtors account? We will have to debit the debtors account with 393. Let's just update our debtors account here somewhere. What did we write off here in total? We've written off in total 180 Rand. Oops, no, this one, I don't know how she's done. There you go. Less 180 Rand, and now said, well, there was a credit balance, so what are we going to do? We're going to debit this account with 393 Rand. So all these lazy people who do tables like this one. So we're going to debit that with 393 Rand, and we would credit our creditors account with 393 Rand. So if we credit this account, that would also increase with 393. Again, it doesn't want to show that because this has been a lazy way that they've done this table. There you are, plus 393 Rand. So if we go to our journal entry, our physical journal entry, debit debtors control, statement of financial position, 393. Credit creditors control, statement of financial position, 393. We have skipped a few here. Number 4. received 457 Rand in cash from a debtor whose account was previously written off as irrecoverable. So obviously bank would have been debited with 457 and credit losses recovered. An income account would have been credited with 457. Guys, if you've still credited debtors with this amount, then I don't think that you know quite a lot about this subject, and probably you will need to study day and night if you want to pass. Right, 5. Rental income is subject to a 10% escalation every year on the 1st of August. Rental income has been received up to 30 April 2014. Now our year end is 31 December. So that means we have received in total how many months? 12 months for the year plus the 4 months in advance. So we have received 16 months worth of rent. From the 1st of January to the 1st of August equals 7 months. 7 months we have received a normal rent of X. Now 7 minus 16 give me 9 months. So for a period of 9 months, we have received the escalated rent with 10% escalation. Rental income in our trial balance is a total of 25,350 Rand. So that is what's currently lying in our books, equals 25,350 Rand. If we now go through all these slopes and schleps and all kinds of things to work out exactly what is the total income that we've received, it is 7x plus 9 multiplied by 1.1 equals 25,350. And if we go right through the process, we see that x is 1,500 Rand. Remember that what we've received in advance is not 1,500 but 1,500 multiplied by 1.1 because we received the increase of 10% already. We have also received 4 months, January, February, March and April's rent in advance. So in total we have received 6,600 Rand in advance. So rental income. In our income statement, we've seen that we have an income account. I've shown it to you. We have an income account on our trial balance of 25,350 Rand. So we have to take out of that account the amount that represents next year's income. So obviously, if we want to reduce this account, we have to debit this account. Otherwise, it's going to increase the balance. So we have to debit this account if we want to decrease the balance. So we're going to debit the rental income account with 6,600 Rand, that's 6,600, and we're going to create income received in advance. Statement of financial position, that income received in advance is going to form part of trade and other payables, and in your note for trade and other payables, that would be shown as an other payable. And that statement of financial position, 6,600 Rand. Great. During a severe thunderstorm, the information systems of Veronix traders was struck by lightning and therefore all employee expenses could not be paid out for the month of December. All employees' expenses that were paid during the year before the thunderstorm is shown in the trial balance. No employees were appointed or dismissed during the year, so there was no fluctuation, and there were no adjustments to the salaries of employees. So that means in simple terms that all the employees received for the full year up to the end of November exactly the same salary. And therefore the deductions for the full year was exactly the same. If we move back to the trial balance, we see that our salaries here is 143,000. Now that 143,000 represents 11 months. Let's try here. That represents 11 months salary. So if I divide it by 11, which it doesn't want to show me, I'm going to do it there underneath. That will give us, I'm going to write it in here, 143,000 divided by 11 gives us a total of 13,000 per month. Now, if we want to work out what was our deduction rates, if we take the 28,600 and we divide it by 143,000, we see that the pay-as-you-earn rate that we have to work with, remember, nothing changed during the year, so that gives us 20%. 28,600 divided by 143,000 gives us 20%. 1430 divided by 133,000, you can see it with your eye, equals 1%. And that's the employer contributions to the UIF. The employee's contributions is exactly the same. Also 1430 divided by 143,000, and that is also 1%. Then pension fund contributions by the employer gives us 21,450 divided by 143,000. And once you've calculated that, you will see that is 15%. Then the employee's contribution is 14,300 divided by 143,000, and that gives us a total of 10%. Great. Now, if we know that our monthly salary was 13,000 gross salary, we can now determine all the deductions ourselves. So for the last month of the year, pay-as-you-earn would have been 20% of 13,000. UIF by the employer, so the employer's contribution, would have been 1% of 13,000. The same applies to the employee's contribution. The employer's contribution to the pension fund would have been 13,000 multiplied by 15%, and the pension fund contribution of the employee would have been 13,000 multiplied by 10,000. So let's go and have a look at the journal entry. Good. We say number 1, our salary account. Our salaries account, statement of profit and loss, would have been debited with that gross salary of 13,000. So here we would have added that 13,000 to our salary bill. So debit salaries with 13,000. Now we're going to do the deductions, and we know that the employee's deductions is going to be deducted from his gross salaries in order to determine his net salary, and that is the amount that the company or the entity actually owns or has to pay out to the employee at the end of the month. So therefore, pay-as-you-earn, we said, is 20%, so 20% of 13,000, 2,600. There's a funny pension fund. The pension fund contribution of the employee, we've said that that amount is equal to 10%. So 10% of 13,000, 1,300. UIF, we said, is 1% of 13,130, and that means 13,000 less the employee's deductions, the 2,600, the 1,300, and the 130 rand, gives us a net salary that we owe the employee 8,970 rand. And that will go to our creditors, salaries accrued or salaries payable, which is a liability account as part of trade and other payables of 8,970. Then the employer contributions. We said that the employer contributes 15% to the pension fund. So 15% to the pension fund, we've already said, so it's 15% of 13,000 rand, and that would have been a total of 1,950. And then he also contributes 1% to the UIF, which is 130 rand, so we would have credited our UIF creditor 130 rand. The sum total of the employer contributions is 2,080, and that we would have posted to the salary account as well because it's a salary-related cost. Employee benefit cost or salaries or salary-related cost, statement of profit and loss, 2,080 rand. Right. The next one. That was number 6. On 1 January 2012, now 1 January 2012 is the previous financial year. Rolex traders borrowed 2,550,000 from Line Bank. Now if we go to the trial balance, we see here that loan from Lion Bank is just a question mark. So obviously you have to fill in the blanks. So at the beginning of the previous financial year, they've borrowed an amount of 2550. The loan is repayable in annual payments of 508093, which includes capital and interest on 31 December every year. So on 31 December 2012, the first payment would have been made, and that was also in the previous financial period. So 31 December 2013, the second payment would have been made on this loan. The loan bears interest at 15% per annum. So what we have to do, because the repayment includes capital and interest, you have to split the installment amount of 508093 into those two components. Because they don't give you the opening balance of your outstanding loan account in the current financial period, you will have to calculate that as well. So you have to start right at the commencement of this agreement and work out all the necessary figures. So we're going to start off with the outstanding loan amount of 2550. We're going to work out our interest at 50% per annum in the 2012 year in order to determine the interest portion of that 508093 of last year, so that we can work out how much capital was repaid last year. Because on that amount, on the actual outstanding capital amount, we're going to calculate our 15% interest of the current year. Let's see what I'm all babbling on about. The outstanding loan on 1 January 2012 was 2550. On 31 December 2012, we have made our first installment of 508093. From 1 January to 31 December 2012 is a full 12 months. So in the 2012 year, our interest would have been 15% of the outstanding loan amount for 12 months. So 12 divided by 12, the full amount, and that would have given us 382,500. If we have paid a total of 508093 and the interest portion was 382,500, it means that the difference between the two was the capital that was repaid in the previous year. So what was our outstanding capital balance in the beginning of the current year? It was the 2550 less the 125593, which gives us outstanding capital of 2424,407. And that is the amount on what you're going to use to calculate the current year's interest of 15%. So you're going to take 15% of the 2424,407, and that gives us interest in the current year of 363,661. We haven't paid only the 363,661, we've paid them on 31 December, the full installment amount of 508093. So if 363,000 was interest, then the difference between those two must represent the capital that we have repaid in the current financial year, 144,432. So let's go and account for our repayment. We're going to debit the Lion Bank loan account, which is statement of financial position. That is, and remember, for the short-term portion and the long-term portion, that is purely for disclosure purposes. So we're not going to pass any accounting entries for that. We only do that split if we're going to disclose this loan in the statement of financial position. But when I do my accounting entries, I do not do that distinction. I'm only going to take the total amount of capital repaid for the year, and I'm going to reduce my outstanding loan amount. So I'm going to debit my loan account with that amount of 144,432. Then I have to account for the interest that I've incurred in the current financial period, the 363,661. So I'm going to debit my expense account in the statement of profit or loss with the 363,661. And I'm going to credit bank with what? The full amount that I've paid. And what did I pay? The installment amount of 508093. So the capital portion goes against the loan account. The interest portion goes against the income statement account, which is an expense account in this instance. Great. Please have a look at this. Make sure you understand the amortization table and make sure that you can do the split and make sure that you can do the journal entries associated with that. Allowance for credit losses must be adjusted to 3% of outstanding debtors. Now, don't forget that we've made certain adjustments against our debtors account. So if we want to work out our actual debtors balance, it would have been the 15,000 less the 180 plus the 393. And that then gives us a total balance on our debtors control account of not 15,000 anymore, but an amount of, oops, I don't want to do that one in yellow. Okay. It's going to be then an amount of, let's do inventory, 15,213. That portion I don't want to be scribbled through. So that's going to be our end, our closing balance. 15,000 minus 180 plus 393 gives us 15,213. So if we then take our 15,213, multiply that by the 3%, this guy's not a VATable entity, so that means that we do not take any account of any VAT whatsoever. That will give us then a total of 456. And that is what we want the closing balance to be on our allowance for credit losses. We have to check then whether we have an existing allowance for credit losses, and we see there we have a 750. So we no longer wish to have that balance of 750. We would actually love to have a balance of 456. So what kind of balance was this? Here I showed for you on the trial balance was a credit balance. How am I going to reduce a credit balance? I'm going to debit that account. So I will debit that account with a difference between 750 and 456, and I will credit an income statement account, either credit losses or credit losses adjustment account with that amount. So the difference there, to get the 750 equal to 456 equals an amount of 294. So I'm going to debit my allowance for credit losses account, statement of financial position, 294, and I'm going to credit my credit losses expenses account or credit losses adjustment account, but that is a statement of profit and loss account, so income account is going to be credited with an amount of 294. During, I think we've done that one, depreciation number 9. Vehicles are depreciated using the kilometers traveled, i.e. the production unit method, at 60 cents per kilometer. And then they give me my cumulative odometer reading as at the beginning of the year, but it's only question marks. Now guys, they tell us that we're going to write off, or the rate that we're using is 60 cents per kilometer. We have our total accumulated depreciation as at the beginning of the year, 34,194. And we know here that 34,194 equals 60 cents per kilometer. So that then means that our outstanding or our odometer reading at the beginning of the year was 56,990. Now, if we have our outstanding odometer reading and we have our closing odometer reading on 31 December, then we can work out how many kilometers did the vehicles traveled in the current year. And then the difference between those two multiplied, we have the rate per kilometer, 60 cents per kilometer. We're going to multiply the number of kilometers driven in the actual year with the 60 cents per kilometer to get to our depreciation charge. So there was our odometer reading at the end of the year. Here was our odometer reading at the beginning of the year. So we've traveled 12,858 kilometers in the current year. Now 12,858 multiplied by the 60 cents per kilometer gives us a total depreciation charge of 7,716. So we're going to debit depreciation, statement of profit and loss, 7716 or 7715. This is just rounding. Let's make it a 6 so everything is the same. And we're going to credit accumulated depreciation then with the amount of 7716. Accumulated depreciation, that is statement of financial position. Right. Then equipment. Equipment has an estimated residual value of 4,900 Rand and it is depreciated at 20% per annum on the reducing balance method. Now we know that on the reducing balance method, we do not deduct the estimated residual value in order to derive at the depreciable value. Why not? Because that estimated residual value of 4,900 Rand is already built into this 20% that you see there. So if we would have deducted that once more, it would have meant that we're going to duplicate that estimated residual value in our calculations. So we've said that the reducing balance method or the diminishing balance method is the only method where we ignore the estimated residual value when we do the calculation because it's already been taken care of. Now the reducing balance method says I have to take my cost price of my equipment, 100,000. I'm going to subtract from that my accumulated depreciation as at the beginning of the year, 45,454. And that gives me my estimated, or not my estimate, my actual carrying value of my equipment at the beginning of the year. I'm going to multiply that by 20%, and that's going to give me my depreciation charge for the year. So the 100,000 less the 45,454 gives me a carrying value at the beginning of the year of 54,546. Multiply that by 20%, and that gives me my depreciation of 10,909. So I'm going to debit depreciation, statement of profit and loss, 10,909. I'm going to credit accumulated depreciation, statement of financial position, 10,909. Good. Now 10, 11, and 12 and 13. 10 to 13, that is everything that has something to do with inventory. So that is the B part of the question. They've told us here, now although this is not a manufacturing environment, they've told us here that all purchased goods are transferred from the warehouse to the sales department at a profit rate of 10% on the cost price. Guys, exactly the same principle. So again, they build in an unrealized profit into the figures. Here they do confirm to us exactly what we've now gathered for ourselves, that they uses a periodic inventory system. And then they tell us that all unsold inventory, so closing inventory in the beginning of the year, closing inventory at the end of the year, is carried at cost plus 10%. So what does that mean? That means that our completed goods, our finished goods, our trading goods in this case, includes unrealized profit of 10%. And then they give us our closing inventory balance as at the end of the year, which is 19,800, and obviously we know that it includes a 10% unrealized profit. Number 13 tells us that closing journal entries to calculated gross profit has not yet been calculated. Guys, how do we calculate gross profit? Gross profit equals sales less cost of sales. Now sales is there. All what we're going to do is we will transfer our sales to our trading account. So we're going to debit sales and we're going to credit, oh yes, a little mistake. We're going to credit our trading account with that amount of 740,545, then that is out of the books. Please note that freight charges on sales are not deducted from the sales figure. This freight charges on sales is a normal operating cost and will be shown underneath the gross profit line as an operating cost. So number one, we're going to debit sales, credit trading account 740,545. Now we have the purchases, the freight on the purchases, and the customs duty. So the first thing that we're going to do is we're going to transfer these purchase-related costs to our purchases account. And then remember what they've said is when they do transfer from the warehouse to the sales department, they're going to increase that actual cost, i.e. the 540, the 2,000 and the 4,550 with an additional 10% when they transfer it to the sales department. So the easy thing to be, number one, is firstly to close off the purchase-related costs to the purchases account. Then get my total purchases up to that stage and then transfer the, calculate 10% and then calculate the inflated cost that will be transferred to our cost of sales. So let's have a look what it looks like. Here's the journal entry to close off our purchase-related costs to our purchases. So we're going to credit freight on purchases with 2,000 Rand. There it is, freight on purchases. It had a debit balance. To get it out, we're going to credit this account and debit purchases with 2,000 Rand. The other one we said is customs duties. So we're going to credit customs duties with 4,550. If we get here to customs duty, how are we going to get rid of that one? We're going to credit that account 4,550, and the debit side, the leg of that entry is going to go against purchases, 540,000. So purchases would have been debited with 6,550. Let's go to the T account. Where's the T account? So that you can see exactly what are we doing. Just find it. Here, purchases. It had a balance of 540,000. We've added now the freight charges of 2,000. We've added now the customs duty of 4,550. So if we add these two, those three together, it gives us a total of 546,515. So now we're going to pump it up with a 10% unrealized profit. So 10% of that amount shaded in there, gives us 54,655. So we're going to debit, in this case now, the purchases account with a 54,655. That's 54,655 that you see there. And we're going to credit the unrealized profit account, and this is the P&L account, with that amount of 54,655. So you can transfer that or put that entry through your books separately. Let's see if I've done it somewhere. Yeah. Going to debit purchases, 54,655. 54,655. Going to credit unrealized profit P&L, 54,655. Great. Now, you know, in a periodic system, how are we going to record for our cost of sales? The first thing is our opening inventory. We're going to take opening inventory out of our books. So we're going to credit this account with 33,000 and we're going to debit our cost of sales account with 33,000. We also know that that 33,000 includes a 10% unrealized profit. So by doing our T account for our allowance for unrealized profit, we know that the opening balance on our allowance for unrealized profit was the 33,000 multiplied by 10 divided by 110, which gives us 3,000 Rand. So you can put that in the meantime in your T account and just park it there for the moment. Here's the transfer of the opening inventory, 33,000. We take it out of our inventory account in the trial balance, so we're going to credit it, and we're going to debit the trading account or the cost of sales account with 33,000 Rand. Good. The question tells us that our closing inventory was 19,800 Rand. So obviously we're going to debit our inventory account at year end with that amount of 19,800 Rand. There it is. And we're going to credit cost of sales, so our trading account, with a 19,800 Rand. Inventory statement of financial position, trading account or cost of sales statement of profit and loss. Because we have the value of our closing inventory, that tells us that that includes the unrealized profit, we can now determine what is going to be the closing balance on the allowance for unrealized profit. So the closing balance is going to be the 19,800 multiplied by 10 divided by 110, and that gives us 1,800 Rand. So how are we going to make the closing balance 1,800 Rand if the opening balance was 3,000? By passing a debit entry on this account of 1,200. And that we're going to take to the unrealized profit P&L account. So 1,200 debit there, and we're going to take the 1,200 credit there to the unrealized profit P&L account. Great. There it is. Allowance for unrealized profit, statement of financial position 1,200, and we're going to credit the unrealized profit P&L account, which is a statement of profit and loss account, income statement account, 1,200. So now we're done with that one. Great. So the only thing that's really now left that we have to do, we've done the purchases. We now have to transfer the total purchases balance to our trading account. So therefore, we're going to credit purchases to get it out of the books and debit the trading account or the cost of sales account, 601,205. Debit the trading account or cost of sales, statement of profit and loss, 601,205, and we're going to credit purchases, 601,205. Then we have dealt with the allowance for unrealized profit. We've dealt with the purchases. The only other one that we have to finish off now is this account. And what is this account? That is all the unrealized profits, and that we have to adjust our cost of sales amount with the unrealized profit that was lying in our books. So that 54,655 we said we received from our purchases account. That 1,200 we have received that from our allowance account. So therefore the balance on this account, the 55,855, that still needs to be transferred to cost of sales or trading account. So clearly here, to get rid of this account, I have to debit this account with 55,855. And I'm going to credit cost of sales or my trading account with 55,855. Unrealized profit, that is my P&L account once more. Debit with 55,855, and I'm going to credit my trading account or my cost of sales account, 55,855. And then I'm done with all the journal entries associated with inventory. Good, now it's only 14 and 15 left. The last two figures in the sales transaction of 21,393 for cash was swapped by mistake by the accountant when he records the entry. So it should have been 21,393. Oops, 393. What did he post? He didn't do that. He posted 21,339. So you swap the last two digits around, and that gives you 54 Rand. It was for cash, and it was for a sales transaction. He only recorded 393, or he recorded only 339, he should have recorded 393. So he has to increase his stakings, his cash stakings, and credit his sales with the difference between the two. Just see here. So our debit bank, 54 Rand. Oh, and yeah, I forgot the, so that's statement of financial position. With 54 Rand, and you're going to credit sales, profit and loss, with that amount of 54 Rand. Great. Then the last one, the creditors column in the cash payments journal was incorrectly added, resulting in an overstatement of 300 Rand. Now, if there was an overstatement, what would I have done? I would have credited bank and debited the creditors account with 300 Rand. But this is only a calculation error. So, what is wrong? Bank is not necessarily wrong. I'm just going to rectify that. The bank column is not wrong per se. So there's no problem in my bank account. The problem lies in my creditors account. Why? Because what did I do? I debited the creditors account with 300 Rand too much. Now I'm just going to rectify that entry, and you do not get a thing like a one-legged entry, but I'm going to show it to you like a one-legged entry, but all you're really going to do is you're going to rub out the old total and write in the new total. There's no physical journal entry. No computerized system will allow you to post any one-legged entries. So creditors control would have been credited to take out the overstatement of the debits which was posted against the creditors control account of 300 Rand. Then furthermore, a payment to a creditor was incorrectly recorded in the journal as 49 Rand instead of 94 Rand. So what is the difference then again between those two? It's 45 Rand. So what did we do? Furthermore, a payment to a creditor was incorrectly recorded in the journal as 49 Rand. So we haven't recorded enough credits. Do you agree? So what are we going to do? We're going to debit the creditor's account with 45 Rand, and we're going to credit bank with 45 Rand. Creditors control, going to debit, statement of financial position, and bank we're going to credit, which is also statement of financial position. And then we're done.